So we'll go ahead and get started. Again, my name is Brandon Abbott. I'm one of the managing partners at PassiveInvesting.com, and we're going to be talking today about the different types of multifamily assets. And again, for those of you just joining or hopped on after I gave this, I've got a little bit different background here. I'm not in my office, so I apologize for any echo. But we're going to kind of, and I'm doing this while I'm standing, so I don't have as many resources in my multiple monitors as I normally have, so I'll do the best I can. So I appreciate your patience with that. But want to just dive into different types of multifamily assets and what all that entails. And so you can try to determine what's the best plan of action for you and your multifamily investment needs. If you're looking to start a syndication business yourself and you're new to it and you're trying to learn some definitions, that's what we're trying to do here, is teach you some of those things. So what is the definition of a multifamily asset is what we're really going to start with. You can see that on the checklist over there. And I apologize, I don't do slides. I don't do anything. I'm going to keep this slide up here just so you can kind of keep the bullet points here. But multifamily is obviously, as it sounds, multifamily, more than one family structure. Anything multifamily is over 5 units, so anything under 5 units is really doesn't fall into that category. So anything 5 units and above. And then you're going to have the different types of multifamily assets. And we're going to go through that right now. But to start out, we have, just to go over, we have A, B, C, and D multifamily assets. And so obviously you can see that's just a grading scale to determine the class of the asset. And most of these are going to be determined on how old they are, but also on where they are located. So as we go into this, we'll talk about not only the asset class, but also the area, geographical area where it's located and how that is rated. So the number one, the top class or the nicest class is the A class. A class is going to be your newer assets, within probably the last 5 years. Sometimes you get some a little bit older than that, but typically within the last 5 years being built or new construction even. And then within the class A multifamily assets, you also have some different ratings in there, because you have like AAA, which is going to be kind of your downtown, just think like downtown Miami high-rise building. That's going to be a luxury, so that's going to be like a AAA. But we tend to stay more in the A class, so that's going to be either your garden or mid-rise, suburban, more suburban, or a little bit urban assets. That's going to be your normal A class, not really luxury, but on the nicer side, on the newer side of things. The reason we like this asset class is because of the stability of this asset class in the resident base. So what we're looking for here is a strong renter demographic. So we're looking at income levels. They tend to be higher than your B, C, and D assets. They tend to be residents that are more concerned about renting for the convenience than opposed to renting out of necessity, whereas some is your B and C, or what we call workforce housing. There tend to be more of a need to rent. There's two issues with that. If somebody chooses to rent as opposed to needs to rent, they are doing it out of convenience, so they're paying for the convenience, so you can get a higher rent premium. Also, you're not going to lose that resident as much to moving into a house. So some of your B and C assets, it may be a stepping stone, maybe a new couple or a new family, and as they're having children and they need a bigger place, you may lose them to a single family home, and so your retention won't be as high. On the A class, you tend to have people that that's their permanent residence, and you can have people that are consultants or work for firms and move around, and they can't be tied down to a single family location or don't like to, and they like the convenience of it in that they don't have to mow the grass or fix anything. They can just call and have that taken care of for them. So it's definitely willing to pay for the convenience factor. The resident base in the class A tend to have a higher income. So the percentage of income to rent, even though the rents are higher than what you'd see in a B and C, which is what scares most people away from the A class assets, the percentage of rent, the ratio of rent to income is much lower. So whereas in a C, let's say in a C class, your rents are, anywhere from 700 to 1,000. your average incomes are much, much lower. Whereas when we move to the A class, where your average rent's maybe 1,500 on average, and your top being 2,300, the average income there would be in upwards of 80,000. And so we like that because it's a less of an impact. The housing cost is less of an impact on their overall budget, if you will. Also, this being a more professional renter demographic, they tend to be more concerned about their credit and the impact that non-rent payment would have. So in economic downturns such as COVID, collections are stronger and you don't have to worry about that as much. And with the higher rent premiums, my break-even occupancy is much lower. So we get down in the 50 to 60% range on break-even occupancy, as opposed to a B or C class that may be a little bit higher than that. And when I say break-even occupancy, I mean the point at which the occupancy level drops. If it drops below a certain percentage, then we are no longer able to make the budget that we have underwritten. And so that occupancy, if it's 60%, if 60% is occupied, we can still pay all the bills. And that's at full staffing. So we're only at 60%. We would obviously have less staffing, less needs. And so our expenses would actually drop a little bit, but that's basically why we like the A class. They tend to be in up and coming or growing areas, kind of in A class areas. So you're also going to have areas that are A, B, C, and D as well. So if I had an A class asset, a newly built asset, but it was kind of in a bad part of town, there's going to be a little more risk associated with that. So an A class asset in an A class area is going to be really the sweet spot that you're going to try to look for. So that is basically the A in a nutshell. And if you have questions while I'm going through this, please put them in the chat and in the Q&A, preferably the Q&A, so I can kind of sort them that way. I'm not able to look at them while I'm going right now because it kind of gets in the way of my screen. And so usually I'll kind of keep an eye on those as I talk, but this time I'm going to kind of jump to those at the end. So let's talk about B class a little bit. And so B class is going to be your next step down. So, for us, B class is going to be kind of a 2000 to current asset class, typically a garden style. And garden is where you have the exterior breezeways with stairs. So garden style walk up with a surface park. So just like a normal parking lot area, that's going to tend to be your B class. You can have some B class that are more urban and mid-rise, but they're don't tend to be classified as a B class. So B class is going to be a little bit older, over 10 years old. And it's going to have usually a value add component to it most of the time because of being of the age of over 10 years old. The color schemes or whatnot, the flooring, the fixtures have gone out of date, and you're going to need to do a little bit of work on that. But still, overall, it's in good condition, not a lot of deferred maintenance, but it's another price point down. So it's not the creme de la creme, if you will, the up and coming, the nice brand new, shiny asset, but it's very nice, well maintained, a little bit more mature. You have residents that have been there for many years, so you have good retention there. But as I mentioned before, with the A class, you're going to lose some of those tenants that are buying houses because that tends to be the demographic. They're using that as a stepping stone to have their own home more often than with the A class. So the B class is a very good asset. We have B assets, but we tend to go more towards the A class assets. And I'll touch on a little bit more of the business model of why we like the lease ups actually in the A class. But that's the B class asset. Right now, with the way the market is, we don't like the heavy value add, which is going to be your C class assets, where it's more of a complete turn where you're updating everything in it: appliances, granite, flooring, fixtures, cabinetry, everything about it in the C class tends to have to be replaced because it's just older and more worn. With the B class, you might be able to paint it, change out some fixtures, maybe address the flooring if necessary, but definitely a lighter value add. In the current market, value add is hard to justify because of the rent growth that we've seen. You have inflation occurring, which is not only driving up the cost of the remodel and the CapEx project, but it's also driving up rents. And so you're able to achieve, in most cases, the rents that you underwrote for in your pro forma without doing the value add. And because there is a quote unquote premium or an upside to the value add in the broker and seller's minds, they tend to want a little bit of premium. So you have to they're basing the sale on the stabilized rent. So they're saying, okay, you can do X, Y, and Z, and in year one, this is what the revenue should be. So you're buying it. They're basing the cap rate on that, but the actual cap rate is usually lower, and at least what I've seen right now is lower than your A-class brand new assets. And so that for us does not seem to make sense from a financial model to risk spending capital and having that and still being able to achieve your rents if you didn't spend that capital. So that's kind of why we're steering away from the traditional value add at this time. We do have properties that we purchased before the current market cycle where that occurred, and so those are fine. We're still proceeding with that, but we look less at the value add properties than we did a year ago. So that's your B class. Your C class is going to be more of your workforce housing. So this is going to be your 80s and 90s product. It can even include some 70s product, but definitely older. Going to have some more infrastructure issues. You're going to have to be checking what your plumbing is made out of, what your electrical is made out of. Is it aluminum? Is it copper? Is it polybutylene, plumbing, different things like that? You're going to have to check because there were some issues and some recalls during those construction time periods, especially in the 80s, 70s, and 80s, that your lender is going to want you to fix. Most of those have been touched on as they've been turned and handed over to different owners. So a lot of it's been taken care of, but it's still something you have to watch out for. We do not prefer this asset class. They tend to be, like I said, a lower rental premium. And what we have discovered in our experience is that it takes just as much time to purchase a C class as it does to purchase an A class, even though you may see a difference in pricing, the overall dollar amount, and that scares a lot of people away, but it doesn't take any more work. And actually it takes less work for the A class as it does the C class, because in the C class, I'm going to have some loss of income as I turn those units over, and I have some more risk that I'm going to be able to achieve an unknown in the market. So I'm making an assumption that if I replace the granite countertops, fixtures, and paint it, that I'm going to be able to get a certain rent premium. I'm basing that on, I've looked in the market, I see who else is a like asset. So looking at 80s, 90s vintage and seeing what kind of finishes they have in the property and seeing what they did. And so the thought is, if I bring it up to their level of finishes and they're achieving a higher rent premium than me, then I will be able to achieve the same rental premium as them. But as I mentioned before, that's occurring without even doing the value add. So, and with the A class, you tend to have warranties, especially with the new construction sites. So they're brand new. So if something goes wrong, I can go back to the contractor and have it fixed. If it's a 70s, 80s, 90s deal, you're not going to have that benefit, and definitely have some infrastructure that's nearing its life expectancy and may run into more trouble. So we just say, why worry with that risk? And we go straight to A. That doesn't mean that it's not the right fit for you. There's many people that are in the C class. We have colleagues and friends that are in the C class space. It's just not something that we at PassiveInvesting.com choose to play in at this time. We started out in the asset class and very quickly switched to a different to the B and the A asset class. It's just a lot of work tracking your contractors and making sure things get done on time, the scheduling, having down units and leasing. There's a lot that has to move there, plus the cost of it. If you can finance it into a called bridge loan, then that's good, but you have to work on draws and they want a budget, and so there's a lot of complication there that is not necessary if you get into the A and B class that don't need a lot of work. So that's why we fall in that. And then on the C class, these tend to be a lower income earners in your resident base. And so there's a lot more collection issues. Your retention is lower because it cycles through. You have people that are that rent because they cannot buy a home. It's not that they don't want to, but they are unable to because of credit or different things like that, or can't save up a down payment. So they've been living in apartments most of their life, and some of the people, not all, there's many good people in the C-Class, but we have some more what we call professional renters in the C-Class space than we do in the A-Class space, where they are okay with dipping out on rents and leaving you with a mess, and they don't worry about their credit. So any kind of collections are really kind of a waste of time there in C-Class. So, and there, as I mentioned in the beginning, your rental income, your rental cost to income is much higher. So if you're, $30,000-$40,000 income and you're charging, $1,000 rent versus $80,000 to $100,000 income, and you're charging, $1,500, $2,000 in rent, it has a bigger impact on your resident base in the C-Class than it does in the A-Class. And then, of course, you have the D-Class, which I don't know anybody that's in that space personally. That's kind of the bad part of town, if you will. A lot of crime. You're going to have a lot of issues there. You're going to need a lot of security. There's, usually, like I said, crime, drug activity on the property. It's just not somewhere where we're willing to play. If it's your own money and you feel comfortable with that, then that's fine. With being in charge of investor money, being a fiduciary, it's just not something we're willing to risk, and the upside is just not there. As I mentioned, you're hitting people that are at the top of their income level, and their rents are a big portion of that. So it's harder for you to increase those rents, and there's less upside, in our opinion, in the D-Class assets. So I kind of went through kind of the pros and cons of each asset type. I want to talk about the A-Class and kind of a lease up, and how do we find value, or what's the upside in the A-Class is what most people ask. So if you're buying a brand new asset, how can you increase rents other than what they already are? And the way we do that, it's very much like a value add program, because there is a lot of meat on the bone, and sometimes more meat on the bone than a traditional value add. And that is, when a developer develops a multifamily property, their goal is to get it occupied as quickly as possible. So they're looking at velocity of leases per month and not really rental premium. So they're usually offering concessions or a discount to rent to get as many people in there as possible to sign 12-month leases. We will usually take over right at about, we have some that are taking over much lower, but by the time we actually close on the property, about 7% or higher. And what happens then is we are then coming up against lease renewal. So the people that signed up and we're getting the discounts, their leases are starting to expire, and we are no longer as concerned with leasing velocity, and we are able to bring those rents up to market. Now, we've done the research ahead of time to know that with the concessions and the discounts that the current residents are receiving, there is some meat on the bone in the market. You can raise the rents. They're behind market. So we're just bringing them up to market, and without doing anything except for just increasing the rents on renewal. So there's a lot of upside. We see that, upwards of $300, sometimes more than that, just getting it up to market rents. And another thing that on the upside is a decrease in expenses, because when they're leasing up these properties, they usually have more staff to handle the volume and to be able to make sure everybody is taken care of when they come into lease, because they're focused on leasing velocity. So we can usually drop a leasing agent as soon as we take over, because it's more stabilized at that point in time. And we're not spending as much on marketing as they were before, because again, they're ramping up, it's brand new property. They have to spend more. So not only do we have an increase in revenue, but we have a decrease in expenses with the Class A properties. And anything else, you have now you do have some A's that are not new construction, they're fully stabilized. We have purchased those. There is some room to move there. Right now, with the way the market's going, they move organically. It's just rents are going up, and we're able to push those without doing anything, even though we bought it as what we call a core asset, and that is an asset in which you buy it and you just generate the cash flows. You're not really looking to push the rents. If you can, great, but that's not what we underwrote for. We have some properties right now, especially in the B and the A class, that is the case. We're just buying it, holding it, and generating the cash flows. It generates enough cash as is to give our investors their returns without having to add any value or increase rents. Again, we're going to try to do that if possible. So we're not going to be silly about it and keep rents down, where we underwrote them. If the market is going up, we're going to keep up with that. But we always underwrite conservatively, so undercommit, over deliver in that sense. So that is a little bit, I touched on the investment strategy to find out what type of asset you want to buy. The C-class assets tend to be less dollar figure. So if you're just starting out, a lot of people start out in the C-class just because it's more achievable in the dollar amount and the amount you have to raise. And so if you're just new starting out, you're not sure how much you want to raise, getting a smaller C-class or even a smaller B-class is a good place to start. So I'm not discounting any of the other asset classes. I just want to make sure I'm clear on how they all pan out and what's best for you. So as I mentioned before, we started out in the C-class space in Greenville, South Carolina with our first asset, and we were doing over $12,000 per unit renovation on those to increase rents, just a couple $100, and that was a ton of work, and that was the last full value-add C-class that we purchased. So we learned our lesson very, very quickly and switched to what we're currently doing now. And so I want to go ahead and look at my questions for a minute, and I'm going to take this off of screen share for a second, and we'll jump back in a second. So if you have any questions, go ahead and put them in the Q&A. I'm going to pull that up here. All right, so far we only have one question, so that's easy. You guys have been easy on me today. We are, as I mentioned at the beginning, we're going to keep this a little bit shorter than normal. Usually I'll go the full hour. We are going to cut that a little bit short today. Apologize for that, but want to get as much value as possible. So go ahead and put your questions in the Q&A. So the question is there a listing available that summarizes the different classes? There are different resources out there. We have videos on it. This video will be posted to YouTube as well. You can kind of go back through and take notes on it. It's a little bit static on how to classify A, B, and C. So I gave you general terms, but some people might go a little bit different, especially you can't get real hard on the dates. Like let's say, 2022 to 2019 is A class. It doesn't quite work that way because you also have, because you have some brand new stuff that is more affordable housing and doesn't have quite as nice of finishes. So it's brand new, but it's not what we would consider an A class. So it could be brand new and be a B class. And you have stuff, I see people classify stuff as B class that's really C class, and it really is an oversell of what they're buying. So if it's an 80s product, it's going to be a C class, unless it's just a complete renovation. They've totally redone everything on it. And a question, can you touch on strategies for sourcing Class A deals? And yes, they're going to be the same as sourcing through regular, any deal is going to be the same. So it's going to be broker relations, which I hit on often. That is the key to all of this, is relationships with brokers. And it's about putting out your criteria. So if they know you're looking for C-class assets, they're not going to be sending you the A-class assets because it's a waste of their time. If they know you're looking for A-class assets, they're not going to be sending you C-class assets. So it's about getting with your broker, building those relationships with the brokers in the area that you want to purchase in, meeting with them, having talked with them, discussing the criteria, why you're in that space, and how you're able to understand it and underwrite it. They're going to ask you, what are your kind of metrics that you're looking for? Are you IRR driven, cash and cash driven? Kind of what is it that pushes the deal? That will help them understand what asset is going to work for you. But they're going to, like I said, set that criteria. We don't get C-class assets. Sometimes they come across my desk, but in general, when I get a phone call from a broker, especially on the pre-stabilized deals, that's where you really get these off-market deals. It's not coming through like it's a regular deal blast. They're not going to bring the C-class. They're bringing the A-class pre-stabilized, lease-up deals that are either under construction. We have one right now that we just released that is still under construction. It'll be finished before we close on the deal. It was an on-market deal, but we get some that are off-market. But it's really about letting your broker know what you're looking for. So that's the best way to source it. All right, let me check. Is there a big difference in cash flow within the different classes? Cash flow is directly proportionate to cap rate. And so, as I mentioned before, some of the value adds have been low on the purchase cap rate, so sub 3.5 on caps on value add deals, which is just crazy. It's an over replacement cost. But what they're looking at, as I mentioned, they're looking at year one. So they're saying you can do all these renovations in 1 year, which is highly unlikely. If it's over 100 units, it's going to be very difficult to do. So as your cap rate is lower, your cash is going to be lower. So if you're at a low cap rate in year one, your cash flow is going to be constrained in year one. Year two, it's going to pick up because hopefully we stabilize, but it's really, you're going to see that in year three. So it's going to affect the asset or the cash flows based on cap rate. And your ability to raise rents. And that's another factor. So if I, I'm in a C class and my income levels are at a certain rate, I can't jump 400 because I just simply can't afford it. So if I bought it on a lower cap rate in an A class, but it's just a matter of bringing it up to market, those residents can afford that bump. And so my cash flow will be much, much better in years 2 and beyond in an A class. Another thing that worries people with an A class versus a B and a C, and you'll hear this argument a lot, is the stabilization or the resiliency during an economic downturn. And you'll say, oh, well, if the rents are so high in A class, they're going to be the first that get hit. But that is not the case. We've seen it. We've been through the cycles, at least the COVID cycle with collections and everything else. And we did not see dips in the A class, where we did see some dips in collection in the C class. And then valuations, as cap rates start to expand, really the C class is the first to get hit with that. They're harder to trade at that point in time. You'll have some people that have been sitting on the sidelines with capital that will snatch those up. But your A class, they're still new, they're still going to do well, they're still going to trade well. So we don't see it as a risk, we see it as the reverse. We feel that C class assets are more volatile. And with a cap rate expansion, I believe I said compression before, but with an expansion, they are more stable. All right, let's see here. Okay, good to hear, just sharing about your success there. Get it out. Give me a second while I read through these questions. Okay, so this question is, this person is looking at a smaller C class asset, 27 units in a B market, considering self-managing versus hiring third-party management. What are the major challenges of a self-management approach, and what would you recommend? So there's two factors here that you have to keep in mind. So actually there's more than two, but when you're considering management companies, there are management companies that handle A class and management companies that handle B class and A, and there's management companies that handle C class. Most of the time, your C class managers are not going to do a good job at managing A class. It's a different clientele, totally different animal. Your A class managers are not going to want to manage a C class property. It's just, again, it's more headache than they're worth than it's worth for them. And so they're going to be less likely to do so. I apologize. I'm getting some appliances delivered, which is why I'm at this house and the person's calling right now. So there we go. I just took care of that. So apologize for that brief interruption. But also with the size of the asset with 27 units, it's going to be harder to find. So you have management companies that are they don't touch anything below that. So that's going to be more of a local company, more of you have managers that manage kind of rental portfolios, if you will. Kind of, let's say you had 10 single family houses in a market, you'd have somebody that would manage that. That's going to be more along the lines of what you're going to have to get to manage a 27 unit property. And the rates are going to be much, much higher, or the percentage of income that they're going to charge you for managing property is going to be much higher. In multifamily, where we play, it's usually around 3%, whereas if you get into that, you're going to be talking upwards of 6-7%, and sometimes 10%, because of the small nature. Because there's just not as much revenue there, or they'll put like a minimum amount. You have to hit this minimum amount for managing the property or not. If you're local in the market and you want to manage it yourself, that's fine. It's very hands-on. That just depends on what your business model is. If you want to be passive, then I wouldn't say do it. If you want to be active, then, and that's what you want to do, then have at it. Some people love doing that, and there's no wrong approach to that. It's just what you prefer. But those are kind of the pros and cons of managing yourself and different types of management companies. Okay, so this question is what am I looking for with the Class A asset? So I'm looking at who developed the property, because it's going to affect the finishes and the quality of construction. I'm looking for where it's located. I'm looking at income levels, median income levels in the surrounding area. Who lives there? Where do they work? There's a lot of remote work now, so it's transitioned from needing to be tied to an employment base or employer base, as opposed to people are working remote so they can live on the coast, or they can live and let's say they want to live downtown Nashville, they can, and they don't really have to go into work. You're seeing a lot more of that, so you've seen the coastal properties blow up. So that's changed what we're looking for in an A-class asset. But really, the finishes are a big thing. So it's typically granite and a lot nicer fixtures, and the exterior is usually a lot more. It's not vinyl or anything like that, so a lot more durable and cleaner looking, more luxury look. The leasing office is very swanky and nice and attractive, and that's really what we're looking for, is those nice new shiny assets where people want to move, because when you have these people that they want to live in an apartment, they don't want to own a home, and they have the money to do so, so they want to live in a nice place. They're not trying to cheap out and go and save money. They want to live in a nice place, and that's what we're looking for. So quality, and then like, where is it located? Is it next to a Whole Foods? Is there a Publix, a Starbucks? What's kind of around? What's the walkability score for that asset? That's all going to affect what we're looking for. And then for us, the criteria we're looking for is we really don't mess with anything that's kind of under 30 million in deal size. Most of our deals lately have been around 100 million. We've had some going much in excess of that. That's just where we play. I know a lot of people are not able to do that, and that's fine, but that's kind of the criteria. We just don't want to mess with anything smaller than that, because it doesn't take any more time to buy $100 million property than it does to buy a $10 million property. And actually, it takes more work on the smaller properties, because the lenders see that as a higher risk. So we just feel it's nice and easy, and that's why we go with that route. All right, let me look over here in the chat. All right, so the question is, what's the best way to estimate ARV for a multifamily apartment rehab? So it does not work that way with multifamily. Single family, you're buying on speculation. So you're buying a property that you got, a little bit cheaper than the market is. So you've done your research, and let's say houses are selling for 120 a square foot in the area, and you bought this one for 100 a square foot, and you're going to spend X amount of dollars renovating it, and in hopes of selling it for 120 a square foot. In multifamily, it doesn't work that. What we're trying to do, so multifamily is valued based on the NOI, so the net operating income, and the cap rate in the market. So it's dividing the NOI by the cap rate, gives you the purchase price. So the idea is to renovate in order to raise rents. And by raising rents, you increase your NOI, which increases your sale price. So it's not really the same type of thing as just buying a house wholesale, fixing up so it's more attractive, and selling it for market price. It's all based on revenue. So it's decreased expense and increased revenue is basically what you're trying to do. So if you can renovate a property and it's going to cut down on some of your costs, and you don't have as much maintenance staff because you fix some of those problems, that's a decrease in cost. If you increase the desirability and put granite and stainless appliances and all the rest of it in there, and you can charge more for rent, okay, then you're going to increase your revenue and therefore increasing the value of the property. And there's different ways too. I mean, there's some ways, if it's really old, like an old C-class, the best way to do it is to completely de-tenant the asset and then completely renovate it and then re-tenant it. Because the problem is, if you're trying to reclassify, let's say it's a C-class in a B area and you want to bring it up to a B, you have C-class residents in the C-class property, and the B-class residents, you're going to have a hard time getting them in there. While the C-class residents are in there, it's just a different demographic. And as you're doing renovations, it's under construction, you're going to have a hard time with that. So the best way to do that in most cases, if you're trying to reclassify the property, is to totally empty it out, get all the renovations done, rebrand it, have a launch, and then re-tenant it with the new residents. All right. I have a question about how we structure our capital stack. We do a 70-30 split, 70 being the LP, 30 being the GP. We do a preferred return. We do a 7% preferred return, which has a LP catch-up, and then we do not have a GP catch-up on that. And so that's how we break it down in a nutshell. We do have some waterfalls in there based on the IRRs achieved on a per deal basis. What IRR and cash are you targeting with the A-class assets? That's a moving target. You know, right now with cap rates compressed, cash, as I mentioned before, cash is directly proportionate to your cap rate. So as cap rates compress, our average cash is going to be lower during the hold of the property. So let's say we're targeting a 7 pref, but our property is only achieving a 7 or 6.5 through the hold. You might ask how that works. Well, on the exit of the property, when we sell the property, we would catch up the LPs for any cash flows they did not receive up to the 7%, and then do the splits after that. And so that's how we do that. But we do a 7%. So we're usually between a 6 and a 7 is what we're targeting on the average cash on cash throughout the hold. And on the pre-stabilized properties, your first year is going to be very, very low. You know, 2%, sometimes 3%, because you're bringing it up. So you're not even getting rental income on a lot of the units. But then, you know, years 3, 4, and 5 are going to be much, much higher in a higher percentage and exceeding your 7%. But sometimes that average, even because you're starting so low and ending so high, it still comes out to lower than 7. IRR, you know, it's I would say 10 to 15 IRR right now on most multifamily assets. You know, if we can do better, we get better. But the days of 21 IRR underwriting are gone for now. Hopefully they come back eventually, but that's where we're at right now. All right, I'm going to just scan through, but I think we've pretty much hit most of the ones. If you didn't get your question answered and you're still need it to be answered, I'd be glad to do so. You can shoot me an email, brandon@passiveinvesting.com. We're always accessible, and we're glad to help you as much as possible. Please go and check out our website and some of our resources that we have, some of YouTube channels, and you can get a lot more resources there. But we appreciate you joining us today. Thank you for putting up with my background and the echoing noise here as I'm doing some trying to multitask here today. So thanks again for joining us, and we'll see you in Charlotte for an in-person conference. Everybody have a great day.